Ladies and gentlemen, good day and welcome to Lodha Group's Q3FY22 Earnings Conference call hosted by Antique Stock Broking. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Biplab Debbarma from Antique Stock Broking. Thank you, and over to you, sir.
Thank you, Janet. Hello, everyone, and welcome to 3Q FY22 Investor Conference Call of Macrotech Developers Limited. You may be aware, Macrotech Developers had a strong all-round performance in 3Q FY22 with highest sales booking in last 12 quarters in India business and the best ever quarter in UK business. We expect this momentum to continue on the back of robust business development of 11 JDS since IPO. With that optimism, let me introduce the Macrotech Developers Management, represented by Mr. Abhishek Lodha, MD and CEO, Mr. Sushil Kumar Modi, CFO, and Mr. Anand Kumar, Head IR. The format of the discussion would be a brief opening remarks by the management, followed by Q&A session. Without further ado, let me hand over the call to Mr. Abhishek Lodha. Over to you, sir.
Hi, this is Sushil Modi. Just give us 30 seconds, please. Good afternoon, everyone. Thank you for joining our earnings call today. I hope all of you, your families, and loved ones are all well and safe. We have had a very exciting calendar year 2021 as we got listed and have now completed 3 full and, most importantly, successful quarters of operations after listing. As a listed company, we started right in the middle of the fatal second wave of COVID. And as we report this, we are in the midst of the third wave, which thankfully is not half as bad as the second wave. Amid this challenging environment, we have crossed many significant milestones, but more important than anything, we have managed to deliver what we promised our investors at the beginning of the journey on every single aspect. As a result of this delivery and the tailwinds in the sector, we were able to successfully raise 4,000 crores by way of a QIP, which was taken up by blue-blooded investors. There are 6 important updates that I would like to share with you at the start of this presentation. The Omicron impact, which we have mentioned about in the presentation, but at this point we are not seeing any significant impact. There was no stoppage in construction, and we are taking all necessary precautions with the labor at all the sites. There has been a slight deferment of potential buyers to sites in the first half of January, and at this point we estimate a deferment of about 200 crores to the sales for this quarter, which of course will come back in the following months. A positive take from it is that the third wave would probably have catalyzed more fence sitters into buying their homes, with work from home now being a continuing phenomenon. Subject to nothing further going wrong from here, we see no impact on our full year guidance for pre-sales and continue to guide towards 9,000 crores of pre-sales for fiscal 22. There might have been a little bit of a question mark on the cash flows from the pre-quarter release. The great piece of news is that we use about 750 crores towards the taking advantage of the 50% benefit that the government authorities were offering for payment of approval related costs on or before 31st December. And as a result of this payment, your company has saved about 600 crores, which we would have otherwise incurred in the forthcoming quarters. This savings will have a meaningful benefit because our approval costs have been not only saved but also front loaded, and therefore cash flow in the future quarters will be better because the approval costs will be much lesser than they would otherwise have been. On a broader basis, we expect to continue deleveraging on a quarterly basis and the strength of our operational cash flows is such that we are looking at a meaningful deleveraging on a quarterly basis going forward, and that continues to be a very, very important focus of the company's business plan. Point number 3, we still have about 2,200 crores of surplus from the QIP proceeds, which, as we have mentioned in the presentation, will be used to capture growth opportunities which are available for a brand like Lodha and continue growing through our asset-light, capital-light model. We have so far added 11 JDA projects in 2021, of which 6 were in this last quarter, and the process continues with a clear pipeline visibility for this quarter and the coming quarters. The company's brand, transparent way of working, as well as strength in sales and execution have been very much appreciated by landowners, and we continue to see the desire to associate with Lodha getting stronger amongst landowners in Mumbai as well as in Pune. The details of the 11 JDAs that we have done so far in fiscal 22, first 3 quarters, are mentioned in the presentation. The JDA opportunities that we are focused on involve modest investment, 6 to 7% of the GDV, reasonable time to market, and margins of approximately 18% PBT, which leads to IRRs of 40% or thereabouts. We believe that this capital light model of growth is extremely important because it is resilient. It allows the company to keep growing, adding projects while continuing to deleverage, and this unique combination of growth and deleveraging simultaneously will provide significant strength to your company going forward. Fourth update, I am pleased to update you that we are starting to see an appropriate level of price increases across the different segments in the business. For the first 9 months, prices have grown on an average by about 5% across our portfolio, and in certain parts of the business, they have even been as high as 8-9% growth. For a full year, we expect the portfolio to have a price growth in the range of about 6%, which we believe will lead to demand continuing to strengthen, because as prices move up at a moderate pace, the desire for home ownership gets expedited, and we start seeing and have started seeing better conversion levels. Price growth at or around the level of wage growth, and as you know, wage growth in our country will average 8% or higher, means that it is a Goldilocks scenario for the housing industry, because affordability is increasing, demand is increasing, and margins are also modestly increasing in spite of the inflation in cost, which I'll just cover in a minute. Inflation, as I mentioned just now, is the biggest buzzword these days, and it impacts our sectors in 2 important ways: the rise in costs and the rise in interest rates. In respect to interest rates, from what we can understand from expert analysis, there could be an interest rate increase of between 25 to 50 basis points in the course of calendar year 2022. We believe that that kind of increase is relatively easy for mortgage costs to absorb, and we do not expect that there will be any significant negative impact to demand on account of that kind of an increase in mortgage costs. Given the high degree of competition amongst the lenders, we expect really the focus on mortgaging to continue, and the availability of mortgages, which is a very important factor for home demand, to continue to be quite strong. Secondly, commodity, building materials, and labor prices have increased, and they may even increase further. However, the fact is that the intensity of construction cost as a percentage of sales price in India is quite moderate. In the Mumbai region, it is between 30 to 40% of the sales price, and consequently, even a 10% increase in the construction cost only leads to a 4% impact on margin. And given the fact that we have already been able to increase prices by averaging 5% this year and potentially up to 6% for the year, you will note that the inflation is being passed through, and there can even after that be some expansion in margins. Of course, your company has a significant amount of ready inventory, which benefits disproportionately from the fact that while the prices are increasing, there is no cost inflation there, and that can help further support a growth in margins. The last and most important update is our continuing focus on deleveraging and reducing debt at an accelerated pace in the current quarter and thereafter. Our endeavor is to have a very strong balance sheet and to further reduce debt and the cost of debt both significantly in the next 4 to 5 quarters. And the success of the sales in London is going to further support our deleveraging efforts. Our interest cost in the current quarter will be approximately around 300 crores, and we expect to further moderate that to about 800 crores for the full year in the next fiscal. We will give a detailed update on our plans for the coming fiscal as well as the sales guidance in our upcoming quarterly presentation. I am sure most of you have had the opportunity to go through the presentation and have looked at the numbers. I'll just give you a quick overview of some of the important numbers. Pre-sales were at 2,608 crores, and today we have our Chief Sales Officer Prashant Bindal with us, who will give you an overview of how things are panning out on the ground and how Lodha sales machinery is geared up to increase our pre-sales in the quarters to come. The 2,608 crores number was our best ever quarter in the last 12 quarters, and we were up by 40% year-on-year sales. And you have to recollect that Q3 of fiscal 21 was the quarter in which the Maharashtra government gave the biggest waiver on stamp duty, and in spite of that, the sales in the third quarter of fiscal 22 were 40% year-on-year higher. On the collection side, in spite of the second wave of COVID hitting in the last part of the quarter, they were at a healthy 2,127 crores, showing a growth of approximately 45%. We've had a year where we've had the first 2 months disrupted by COVID and again about 3 to 4 weeks disrupted by COVID. But as the pre-sales are picking up, we expect that the collections will also start climbing up at a faster pace going forward. As you know, in our company, historically, the ratio of pre-sales to collections has been at 100% or better, and we expect that to continue. Our UK projects had their best ever quarterly sales, with Grosvenor Square achieving 177 million pounds, about 1,800 crores, and Lincoln Square achieving 14 million pounds of pre-sales. Indicated earlier, Lincoln Square is on track to be fully sold out in the next 1 to 2 quarters. Grosvenor Square has sold nearly 300 million pounds in the last 4 months and will likely sell out over the next 4 to 6 quarters. And therefore, the repatriation of capital to India will begin in fiscal 23 itself, and we expect the entire capital invested in the UK to be repatriated to back to India in the next 4 to 6 quarters. In terms of the JDAs, as I updated, it was a fabulous quarter. 6 more JDA projects were 10,000 crores added, and this really shows that there is an increasing momentum even on the business development side. In terms of our operating cash generation, we were able to reduce debt by 400 crores from operating cash itself. This, we think, is very important because as collections go up from 2,100 crores in the last quarter to a much higher level of 2,700 crores in the quarters to come, you'll start seeing deleveraging at an accelerated pace. In terms of our progress on the digital infrastructure business, we saw a lot of interest in Palava. We have a global sportswear company setting up their APAC India logistics hub at Palava with 1 million square feet. We have very advanced discussions with a global e-commerce player, which should conclude this in the next 3 months, on setting up a 1 million plus square feet warehouse. We've had a hospital chain take land from us to set up a good size hospital. We've had an R&D company come forward a pharma company come forward to set up their R&D hub. We of course completed transactions with Morgan Stanley last quarter, and now we are in advanced stages of concluding our joint venture with 2 marquee global investors, in which the due diligence is now advanced, and we expect to conclude in the next 3 months, which will allow us to expand our digital infrastructure platform not just in Palava but across many locations. Last and very importantly, we are continuing our focus on the ESG front. we were rated by the S&P Global Corporate Sustainability Assessment Team, and we were found to be amongst the top 13% of the global real estate companies. This was our very first attempt at being rated by a third party, and we have a lot of learnings, and we expect that our scores and percentile rankings in this regard will show a significant upward trajectory over the next 12 and 24 months. We are continuing to focus on simplifying our corporate structure, again with a view to increase the transparency of our business to all stakeholders and ensuring that the business can be easily understood by a wide subsection of investors. In this context, we filed for the merger of 9 unlisted entities in December, and further, the board has approved the proposal to merge 3 of our listed subsidiaries earlier this month. The merger of the listed subsidiaries will of course be subject to approval of the concerned authorities as well as the approval of the majority of the minority shareholders, therefore taking care that all interests are appropriately protected. We continue to focus on helping our society deal with COVID better. In addition to the 60,000 plus vaccinations that we have already administered to our employees, third-party workers, dependents, as well as residents at Lodha Developments, we are now focused on ensuring that booster shots are made available in the biggest possible manner to those who are eligible, as well as helping in the vaccination campaign for the teenagers, which the Government of India has now started. We continue as a company to be very focused and mindful of our obligations as a responsible corporate citizen and intend to take further steps when it comes to giving back to the communities that we live in, and we will update you further in that regard at the next quarterly update. Before I conclude, very quick synopsis of the P&L. The revenue came in at 2,059 crores with a year-on-year growth of 36%. Adjusted EBITDA was 698 crores, up 55% on a year-on-year basis. Adjusted EBITDA margin was about 33%, up 420 basis points on a year-on-year basis. The PAT adjusted for forex impact was 295 crores, showing a 240% growth on year-on-year basis and a PAT margin of approximately 14%. Lastly, and quite importantly, our ratios have improved sharply, and our debt to equity now stands at 0.9x. Summarizing, our focus continues to remain on the duality of capital efficient growth and deleveraging. We are quite confident that the tailwinds in the housing sector and the strength of the brand of this company, combined with the strong execution on sales and operations, will provide us with strong growth momentum in the quarters to come. That's all from my opening remarks, and happy to take questions now.
Thank you.
I'm sorry, before we move to questions, I will request our CSO, Prashant Bindal, to share his observations of the sales circumstances currently. Prashant.
Thank you very much, and good afternoon to all. As Abhishek has pointed out, the consumer sentiments and the whole real estate industry has been having tailwinds for last 15 odd months, and we have seen tremendous consumer sentiments as well as the business opportunities in last 15 months, and quarter after quarter we have seen this improvement. We, from a sales perspective, we look at this behavior from how many consumers are actually coming to our sites and how many of them are actually buying, and that gives us an idea. And where are they doing it? Are they doing in certain projects or are they doing across? That gives us an idea how the overall business and overall sentiments are. So when we look at this aspect, what we find is that the business opportunities, the business is improving across geographies and across categories. If you look at our business, we have divided business into mainly 3 categories. One is the affordable segment, which we call the CASA segment, the aspirational segment, and the premium segment. Now, if we observe the number of consumers who are coming to our site, in quarter 3, that is the last quarter, we had 27,000 consumers coming to our site. Now, 27,000 consumers in 13 weeks is an average of 2,000 walk-ins coming to our site every week. And that is an improvement of over 10%. So if we look at last year quarter 3, Abhishek pointed out that last year quarter 3 was a phenomenal year when Maharashtra government gave the stamp duty benefit. On last year quarter 3, the number of walk-ins were 24,000. On that 24,000 walk-ins, we had 27,300 walk-ins. So we had roughly about 12% increase in walk-ins over last quarter 3. And the conversion was about 7%, 7.2% to be precise, last quarter 3. And this year, the conversion has reached in quarter 3 at an unprecedented 9%. For the first time in last 20 odd quarters, our conversion is touching 9%. So this is unprecedented. So if we look at almost a 30% swing, a 35% swing over last quarter 3, it is about 12% coming from a swing in the number of walk-ins and about 20% coming from a swing in the actual conversion. And if we compare with last quarter we had 24,000 walk-ins, and this quarter 27,200 walk-ins, so roughly about the similar numbers, so about 12% conversion improvement over last quarter and 12% conversion, a 12% improvement over walk-ins over quarter 3, that is last year same quarter. And similarly, our conversion was about 7.6% in last quarter and about 9% in this year. So if on all parameters we see an improvement in number of walk-ins quarter by quarter and over last year and in conversion. And when we look at it, this conversion is seen across categories, whether it's aspirational segment, out of that 27,000 walk-ins that come, about 70%, of course, because the aspirational segments are less than 1 crore, they attract more number of walk-ins. About 68% to be precise, happen in the aspirational segment, about in the affordable segment, about 15% happen in the aspirational segment, and the balance 12% in the premium segment. We have seen almost a similar kind of increase in number of walk-ins across all three segments, and the conversion has been best both in affordable as well as in the premium segment. That is why in terms of value terms, if you will see, the value of premium business is almost equal to affordable segment, almost 2,300 crore in both the segments. So this gives us an idea that there is a momentum across the categories and this across the geographies. So just to give an example, for last quarter 3, if I take two extremes, one is a township segment which is in the range of 50 to 60 lakh, this is the Palava segment. We had as many as 14,000 walk-ins coming in one quarter, that is 3 months, and 1,000 bookings and more than 600 crore business. This is one of the best activations we have had in 3 months, getting more than 600 crore business in one business of Palava. So 600 crore coming up in one quarter. And on the other hand, if we look at say Voltar is our we reckon it as the best developments in the world. We had 600 walk-ins and 30 bookings at a business of 300 crores. Last quarter also we had almost 550 walk-ins, but 18 bookings at 212 crores in Voltar, and this quarter we had 30 bookings at a value of 300 crores. So if you see that there is a continuous movement quarter by quarter, and as compared to last year, both in walk-ins, both as in conversion, in the overall business, and that holds us in stead for the coming quarter. And we believe that this momentum will continue in the coming quarter. We believe that if we can continue with this momentum of quarter 2 from 24,000 to 27,000 walk-ins in quarter 3, if we believe that we can take the number of walk-ins to 30,000 in the coming quarter, that is this quarter, and even if we maintain the same conversion, because 9% conversion was unprecedented, which we have hit for the first time, that itself gives us about 2,700 bookings and takes us to our guidance. And within this distribution, for the first time we have crossed 1,000 channel partners actually booking with us. Now this is unprecedented. These are the numbers which large number of consumer good companies actually show. These are the numbers which the 1,000 distributors are with the largest consumer good companies like Britannia or Marico, who get 1,000 distributors booking this. So we had 1,000 channel partners actually doing the booking with us, and 4,700 channel partners actually bringing the consumers to our site. So these are in terms of the number of walk-ins, in terms of our distribution strength, we believe that we are in a situation where we can we can keep taking advantage of the rising consumer sentiment and our brand strength to take the business to the next level. And generally what we have seen is from the consumer sentiment is that the concentric circle story plays a very critical role. That is that wherever location you come with a project with the 0 to 5 and 5 to 7 kilometer radius plays a very, very critical role. So when you enter a new geography, you actually interact with new set of consumers and new set of channel partners. And that is what we believe, that when we enter into new geographies, we get new channel partners to interact with and the new consumers to interact with. So if we are coming up with 10 to 11 JVs in the coming quarter and in the next year, we believe that this will take our system and our distribution and our consumer sentiment to an absolutely new levels. If in the current systems, current business, we have got 4,500 channel partners we interact with and 1,000 channel partners, which we hope by end of quarter 4 will take it to 1,200. Then in the coming years, in the new geographies, because all our JVs, in fact, the best thing about the JVs is that they've been planned very well. They give us entry into those geographies which we are being hitherto not present. Just to give an example, that Bombay, if you talk about it, Bombay is Bombay. For any consumer in the good industry or anything, Bombay is at the top. If the top 8 markets, if we see, the total real estate industry business is about 220,000 crore business. Out of that, Bombay alone is 95,000 crore. This means that of the 8 markets, top 8 markets, Bombay is about 45% of the total market. And within that 95,000 crore market, we are currently available in a market of about 35,000 crores. And whichever market we are available in, we have a market share of about 22 to 34%. Now, there is a market which is balance left of close to about 55,000 crores, which we are not even present. There is a western segment of 17,000 crore. There is an eastern segment of another 11,000 crore. There is Navi Mumbai of another 11,000 crore. So, and most of these JVs are coming in these geographies where we have not been present. And our goal is that in coming 15 to 18 months, we can have at least 10% of this balance 60,000 crore market. And wherever, this year, we entered into 3 new JDAs. Now, just to give an example, the first one we entered was in Pune. Now, Pune is a 25,000 crore market. Within that, Pune South is 4,000 crore market. And if we look the sub-phase of Pune South, which is a Pune NIBM, where we entered, NIBM area, if you look at that 0 to 10 kilometer radius, that micro market is about 1,200 crore. In 3 months' time, we have done 280 crore business there. And by the year end, we will end up doing almost 400 crore business there. So this means that we will end up doing about 25% of that sub-phase market. Similarly, in Kandivali, we entered into Kandivali, which is western suburb where we have never been present. Now, this is Kandivali East. So Kandivali, if you look at western suburb, is 17,000 crore market. In this, the east part of western suburb is about 4,000 crore market. And if you look at the sub-segment, it's about 1,200 crore. And we'll end up doing 400 crore market. We've already done 300 crore business in Kandivali in 3 months. And we'll end up doing almost 450 crore business. So this means we're just going phase by phase, and all the JDAs are being planned in such a manner that we go step by step, capturing the market share in every phase. And in the next 15 to 18 months, we will definitely end up capturing 10 to 12% of this balanced market share. And along with that, hopefully take the market share, overall the number of channel partners that we engage with to almost 7,000, 8,000. Then the way we ramp up our 1,000 people on the front line, and the digital interface. I think that is the most important thing. So much of business coming, so much of bookings happening, and at that time, almost 40,000 consumers coming to us every quarter. there will be we'll be ramping up our digital interface to understand the quant as well as the qualitative behavior. So this is the way we are trying to work our way up, and hopefully the next coming quarters would be as exciting, and hopefully we can always report the next every other quarter to be the best quarter. Thank you.
Thank you, Prashant, for sharing those insightful comments. We'll now open it up for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead. Mr. Sheth, your line is unmuted.
Sorry. Thanks for the opportunity. So 2 questions. Firstly, I think very encouraged to see 6 deals getting signed this quarter, and out of that 3 in South and Central market. While we are talking about all JDAs that we sign are in the market where we are not present in. So can you highlight which are the exact micro markets that you have entered into through JDAs from these 3 that you have signed?
Hi, Pritesh. So in terms of our strategy is to focus on ensuring that we are growing into the micro markets where we have no presence, and we have supply coming out in the markets where we are exhausting supply. So both those elements of the strategy are playing out together. In terms of the South Central Mumbai market, our projects at Kala Chowki as well as at near KEM Hospital are now essentially fully sold out, and therefore we need to replace that supply around that price point range of around 23, 24, 25,000 rupees a square feet. And those are the kind of new JDAs that we have largely added, which are on the eastern side of the railway line, and more catering to that price point. We have reasonable supply currently available in the 25 to 30,000 rupees a square foot range, which is on the western side, which is Park, etc. So we've not added in that area.
Sure, great. That's good clarification. And secondly, on the 2,200 crore surplus that you mentioned sitting from the QIP. So if I notice that your borrowings have reduced that by that similar amount of 2,200 crore from previous quarter to now. So can we assume like whatever was surplus, you've for now paid out the borrowings, and then after that you will raise it at a lower cost of debt? Is it how the strategy is going to be?
So Sushil will answer that. Yes.
So the debt reduction that you have seen today, that's on the net debt basis. At any point of time, as what we have decided, from a financial liquidity and the capital structure standpoint, that we would be carrying 1,500 odd crore cash at any given point of time to capitalize on some of these opportunities in the form of JDA that will keep coming. And to that extent, as at the quarter in December, our cash balance stands at around 1,300, 1,350 odd. So that's the strategy. So effectively, as you know, we are a company which generates free cash flow effectively on a daily basis. So to that extent, the money in any case is fungible. We keep generating the money, and that keep generating operating cash flow, and thereby keep utilizing for our growth trajectory as we speak.
Okay, no, that's fair. But September, your gross borrowing amount was around 1,500 crore, which is down to 15,000 crore, sorry, and that is now down to 12,900 crore odd. So that is 2,000 odd crore of reduction. So that for now we have utilized our balance QIP amount to repay the debt. That's what my question was.
So Pritesh, if I can add to what Sushil said, just elaborate. And so as he said, about 1,300 crores is being carried as cash with us. And balance, of course, we use as part of our treasury management and optimization. where we have sort of lined up refinances, etc., we might pay it a month to capitalize on the spread on overnight or money market rates vis-a-vis the cost of debt, and then the money comes back in as we refinance.
Sure. Got it. Thank you. That's it from my side. All the best.
Mr. Prateek, does that answer your question?
Yes, that's it from my side. All the best. Thank you.
Thank you. Before we take the next question, a reminder to the participants to please limit your question to 2 per participants only. You may rejoin the question queue if you have a follow-up. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good afternoon, everyone. Thank you for the opportunity. The first question is mainly, I guess, on the sales front. So I think as of Q2, months of August, September, we are seeing 700 crores of sales on a monthly basis. Could you just help us understand from the new launches, right, what has been the uptick in the sales momentum versus the existing inventory and the new launches for the current quarter? That is the first question. And second question, again, just on the construction costs, at the beginning of the year, we had said our budgeted cost is around 2,800 crores for the full year. So I think we're around 1,800 crores in the 9 months. So could you just help us understand the reasons for the variance, if any, which will be there in the full year numbers? Yeah, thank you.
Hi. In answering your questions, I'm just digging up the data on your first question. Answering your second. In terms of the second question, we had budgeted about 2,800 crores of construction spend for the full year. With the impact of the second wave of COVID in April and May, and the modest impact of the third wave of COVID, we expect that for the full year, the number will now end up at closer to 2,450, 2,500 crores. So about 400 crores lower than it would otherwise have been on account of these impacts of COVID. In terms of your first question, for the Q3, an amount of approximately 400 crores came from the new JDA projects in terms of the pre-sales, and the balance 2,200 odd crores came in from our ongoing and existing projects.
Okay, fine. That's it from my side, and all the best. Thank you.
Thank you.
Mr. Chattopadhyay, does that answer your question?
Yeah, I'm done. Please proceed.
Thank you very much. The next question is from the line of Love Sharma from Lombard Investment. Please go ahead.
Hello. Hi, Abhishek and team. Great set of results. Congratulations and Happy New Year. I had one question regarding the London project. So on the inventory financing, could you just share more details? If that has been closed, what kind of terms are there? And then I think you are, of course, looking to prepay the bonds by March this year. So just to understand how that is progressing. Thank you.
Hi, Love. I hope you and everybody at home and in Singapore are well. In terms of the...
Of course, yeah. Thanks, Abhishek. Yes, all good. I hope everything good at your end too. Yeah.
Yes, thank you. So now in terms of the inventory financing, we earlier had a facility of about 325 million pounds that has now been reduced to 225 million pounds because of the level of sales which have been achieved. And it's a 4-year facility at about 5% per annum rate of interest. So those are the highlights of the inventory financing. And the repayment of the bond, as we had updated earlier this month, we expect it to be fully repaid in the next 4 months. And a significant portion might be paid by the 10th of March itself, and from the sales completions as they are happening.
Okay, but are you looking to, based on the timeline you're working towards, do you expect it to be fully repaid by March, or maybe some mostly prepaid and then maybe carried over to the next quarter?
Now, there's a little bit of, the fact is that as the completions happen because of the second wave of COVID, etc., sometimes timelines can slip. So while we have our optimistic case that it might be fully paid out by the 10th of March, we want to sort of, keep a little bit of buffer, and that's why we guided to about 4 months, as it might, some small amount, modest amount might even slip into the following quarter.
So it's more a function of completion rather than any, rather than anything else, because as completion, sales is already done. It's just completion and thereby collection to be utilized for the payment.
Understood. Okay, got it. Yeah. No, thanks, Abhishek and Sushil. Thank you. All the best.
Thank you. The next question is from the line of Puneet from HSBC. Please go ahead.
Yeah, thank you so much. My first question is with respect to the buyout that you've done at Palava. Is it possible to share what kind of valuation were assigned when you did this minority interest purchase in Palava?
No, yeah, so it is basically, Ivanhoe, who was the investor there, who came in 2018. So it's basically given an exit to them and simplifying the structure, which was part of our which is something that was envisaged at the time of IPO itself and was being mentioned there. So they had invested around 500 odd CR in late 2018, and they have gotten an exit now, so you can very well see the numbers.
Yeah. So what was the percentage ownership? If there was a direct ownership for the entire Palava, so 646 is what you paid, right? And how much did they own?
It's effectively, so this was a convertible instrument, so, optionally convertible instrument. So, it was never converted. So what they have gotten is effectively kind of more or less in line with our debt cost, which is, as you know, at the beginning of the year, we were running at around 12% circa. So more or less, that's the kind of, effectively, let's call it as an IRR, on an average that has been given, for this exit.
Okay. And post this payment, will your interest cost also come down, because this could be treated as debt earlier, right?
Yeah, in any case, as we said, that our interest cost continues to remain on a downward trajectory, as we keep reducing our leverage and as our capital structure keeps strengthening. So thereby, by default, the rating profile keep improving, and which will lead to a significant reduction both on the existing debt as well as many debts gets kind of, refinanced at a much lower cost. So you would have noticed that all our incremental borrowings are happening at around single digit, below 10%. So, and we see that should only be going down as we move on. So we, at this point, we are contemplating potentially exiting this financial year by March, in any case, around the circa of around 10%.
Understood. That's very helpful. Thank you so much. My second question is on this, now you guys have more than a year of experience in doing JDAs very aggressively. Have you noticed any change in the terms of the trade from, say, April 2021 to now we are sitting in almost in Jan 2022?
As we are seeing on the ground right now, we are only sort of, at the, I would say, early stages of fully capitalizing on the JDA opportunity. I think the pool is very large, and the willingness of the landowners to associate with the very best brands is very, very high. They don't want to take chances anymore. We haven't seen any change in the terms of the trade in a meaningful manner. Obviously, terms in Mumbai are different from terms in Pune. So Pune and Mumbai terms are different. But other than that, we haven't seen any significant change in terms of, at what levels the deals are happening at, which I understood your question to be.
Yeah, so no implied change in the land prices also in the eyes of these partners.
See, the thing of the JDA thing, and this you would have to take into note, is that it automatically has that built in, because if land prices are going up, that is as a consequence of the increase in end product prices. So if end product prices are going up, and at the same percentage, the guy is going to get paid reasonably, something more, because prices are going to go up. So that's inherently built into the revenue sharing model or the, profit sharing model.
Understood. So you're saying the pace of end product price going up is same as the pace of land price going up, and hence it gets adjusted automatically?
Well, I would say a combination of facts that, end product prices have just started going up in the last two odd quarters. Second, negotiating power is different, so it's not that, you translate it like to like. In a perfect world with equal negotiating power, land prices should move up at a faster pace than the end product prices, but that's not the case right now.
I think more important perhaps, Smith, is to recognize that the landowners, or the various other stakeholders looking brand Lodha duly recognizes and appreciates what Lodha need to deservingly get for putting their brand onto a project, and to kind of effectively convert or make that land parcel into a hard cash at the fastest pace. So, and which is what is relevant from our standpoint. So long our margins are being put on the table, thereafter by default implicitly the landowner also gets a better pie or a better share in the pie as the price keeps moving up. Thereby implicitly the land price is also moving up.
Understood. That's very helpful. Thank you so much. That's all from my side. Thank you.
Thank you. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Thanks for taking my question. My first question is on the land and the investment. This quarter, the spend there was a little lower than our earlier quarter. How should we look at this going ahead, considering like we already are sitting on 2,200 crores of cash earmarked towards it?
Yeah. So I would request you to see the data on slide 25 along with the data in relation to the utilization of QIP proceeds. So from our operating cash, we used 155 crores towards the land and approvals. And in addition to that, we invested 369 crores from the QIP proceeds towards the new JVAs. So as a combination, that number is approximately 515 crores, which sort of is an indication to you of the level at which we've invested into new land and growth. On average, you could expect us to be investing somewhere between 300 to 400 crore rupees a quarter towards the JDAs.
Sure, that's helpful. And my second question was on the interest cost. Just a clarification. Did you say earlier that the interest spend would reduce to 300 crores this quarter?
Yes. So given where we are in terms of our debt as well as the cost of debt, we expect to spend approximately 300 crores. It could be plus minus 5%, but approximately 300 crores for this quarter. And then for the next year, full year, we are estimating it at about 800 crores for the full year, again plus minus 5%.
So what will be the gross debt number for this quarter, Q4?
You're asking me for the gross debt number at the end of the quarter?
Yeah.
Your debt currently as of December, 31st December, it is at around ballpark 11,200 odd crores. The gross debt. The net debt, that's how 1,300 crore cash, if you reduce, you get to the 8,900 crore net debt number.
Okay, great. Thanks so much.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thank you so much and good afternoon, everyone. Abhishek, can you update us on the new launch plans for three South Mumbai projects, Malabar Hill, Tardeo, and Prabhadevi?
Hi, Sameer. The timing of the launches are for the Walkeshwar project is most likely in this quarter. It might, depending on circumstances, always, could slip by a month into the next quarter, but largely it's expected to be this quarter. In terms of the Tardeo project, we expect it to be Q2 of the following fiscal, so between July and September. And in terms of the Prabhadevi project, that is currently not envisaged to start in fiscal 23.
Okay, great. And so when I see on your slide that you are planning to launch 0.6 million square foot in Q4, that probably has only one of these, yeah, which is Walkeshwar.
It has Walkeshwar, the Malabadil project in it. You're right.
And the balance? So that's, I think, 0.2 and total is 0.2.
The balance is at New Corporate.
Oh, I see. Okay, got it. And second question is on digital infra. And just your assessment of demand over there, Abhishek, do you think you can monetize, I think what you plan, 200, 250 acres per annum? That's one. And second, related to that is you have allocated a very large part of your land bank, roughly 3,500 acres for this versus 900 for residential. So what gives you that confidence, and do you think this is in stone, or do you think at some point in time you may want to reallocate this?
Samir, of course, one, looks at business plans from the perspective of the best available information, and as a nimble company, one would obviously optimize if opportunities for optimization were to present themselves. Having said that, the demand for digital infrastructure right now, as we see it, is very robust. We have, as I mentioned in my opening remarks, we have 1 million square feet leased to a global sportswear brand for their Asia Pac / India logistics hub. We've had meaningful demand between 200 to 400,000 square feet from a number of different players. We have about 1 million square feet that we're doing with a global e-commerce player. So overall, what we had guided to of monetizing about 700 crores on an average annual basis of the land towards digital infrastructure, we continue to believe that that number is achievable, and we could also see that as more and more assets class come in. So as I was mentioning earlier, now you have R&D facilities being set up, you have hospitals coming in. You could have some other asset class coming in due course. You could definitely see that range of 700 crores being achieved. Hopefully, we could even better that.
Okay, great. It's just that, Abhishek, the economics per acre or per square foot of residential is significantly higher than for the commercial usage, and that's the reason the question. But I guess you make up on a time value. Is that the thinking?
Samir, I think it's a combination. The land as we have right now, we've said, okay, let's have a plan where we can monetize this land in a very effective manner, in the next 10 to 12 years. And so the 900 acres towards residential, office, and retail is really our estimate of the take-up of land over the next, 10 to 12 years. Obviously, what we're doing right now in digital infrastructure needs to be compared with what we were doing in Resi 10 years ago. You will remember that in Resi, in Palava, we started at 2,000 rupees a square feet 10 years ago, because this is the market creation time. True value realization happens over a journey, especially when you're trying to create a destination of this scale. So I think there will be an improvement in the realizations from digital infrastructure over time. Residential realizations will continue to remain far better than these realizations, but then residential density on a per acre basis is much higher. You can build, 120, 140, 150,000 square feet an acre. So there is, only so much supply that the market can absorb. So that really is the trade-off. But if 900 acres is what we need for the next 10, 12 years, we can always take another 300 acres and extend that to 15 years if the circumstances would tell us that that's the right thing to do on an NPV basis.
I think, Samir, this interplay which you pointed out is absolutely valid, but this interplay will also between the Resi and the digital infra would be always something that we will be closely tracking. If and because digital infra also, as we have discussed in the past, generates a phenomenal tailwind to the Resi demand. So as the Resi demand thereby gets into the virtuous cycle and improves disproportionately vis-a-vis what we have contemplated, because we are keeping more like same 12-15 years whatever is required for the to cater to the residential demand. Keeping that aside, we have allocated the rest for the digital part. But if that happens to be, we start seeing the uptick on that front, sooner than automatically, that means to that extent, the reallocation is always possible and we will always be keeping our eye on it.
Okay, great. Thank you very much. With your permission, if I can ask one last question, that's on your JDA platform. Do you see any risk to these transactions? See, it's only been 9 months, and risk may unfold in 3-4 years of hidden liabilities or any such thing that we need to worry about.
Samir, I think the fact is that business always has risk associated with it, and one could always, there is always the unknown. We have we have done a reasonably strong process of due diligence, and our economic interest is as a percentage of the profit or a percentage of the revenues, and there is always the landowner's skin in the game to deal with any of these unknown or contingencies. So we believe that we have sort of created a fairly robust business model, but life unfolds over time, so I can't tell you absolutely that nothing will ever happen, but we feel fairly comfortable that we have covered most bases.
Okay, great. Thank you so much.
Thank you.
Thank you. The next question is from the line of Anubhav Sinha from Jefferies. Please go ahead.
Hey, hi. Just a quick question. On the net worth on a QOQ basis, am I missing something or there was some reduction which happened?
No, Anubhav, your point is right. That's basically for the exit that we gave to Ivanhoe. So that was treated as equity in the books since investment, and as we have given exit, to that extent, you have to adjust that piece from the net worth. You get the number.
Okay, got it. And second question also, quickly, when you mentioned about this 5% price increase in last 9 months, are there any significant differences among various micro markets or the segments there?
Abhinav, yes, there is a variance over there. The range is as wide as 3% to 9%, and that's really a function of the stage of the development, the competitive intensity, and such other relevant factors. What I can tell you is that the growth is across the board, but obviously there are project level differences in that.
Right. Thank you.
Thank you.
That's it. Yeah.
Thank you. The next question is from the line of Venkat Samala from Tata AMC. Please go ahead. Mr. Venkat Samala, your line is unmuted. Please go ahead with your question, sir.
Hi, am I audible?
Yes.
Yes, sir, you are.
Yeah. Thanks a lot for the opportunity. Abhishek, just wanted your thoughts on the fact that, in Q2 pre-QIP, you did mention that, net debt is expected to go down to 4 digits. So if we were to exclude the capital of QIP and the utilization thereof, so are we on track to meet that guidance, or is there any change to that?
Venkat, our guidance is at a corporate level, and as we've already mentioned, we've sort of brought our debt below 10,000 crores, which was our guidance. In addition to that, you'll have to recognize that the QIP money is something which is going towards investment. So while it is held with us for an interim period of time, it will keep getting invested over into new projects. So it's not debt reduction capital. So we can't really break it up as two different pieces in the manner that you may perhaps be looking at it. We do expect to continue seeing significant reduction in debt on a quarter-on-quarter basis. Perhaps the number will be 700-800 crores on average over the next 5 quarters, per quarter over the next 4-5 quarters.
Understood. That's all right. The second question is actually about this JDA and the pipeline that you are seeing. If you could give some more color, because whatever you had guided for last maybe 3-4 quarters since listing, you did mention about maybe undertaking 2 transactions a quarter. But if we look at the number of JDAs signed, obviously it's much higher than that. So do you think the rate at which you are signing JDAs, is that sustainable? And the second question related to that is, you also spoke about maybe entering into Bangalore market a little earlier than envisaged. So is that on the table maybe in FY23?
In terms of the pace of signing JDAs, obviously, we've raised the QIP subsequent to that initial guidance of 2 JDAs a quarter. We were able to deploy the entire capital of 375 crores that we raised in the IPO by early October, and subsequently we've used the capital from the QIP to further do JDAs. As per our current guidance, as I mentioned earlier in this call, we expect to invest about 300 to 400 crore rupees a quarter towards JDAs, and that would, it could be anywhere from 3 to 4 transactions a quarter. This doesn't have kind of a rhythm. In one quarter you could get 2, in another quarter you could get 5, because there is, all the factor of opportunity, negotiation, due diligence, paperwork, everything has to come together. But yes, we do expect to add, as I mentioned earlier, over the next 5-6 quarters, a meaningful amount of JDAs as we deploy this QIP, the capital that we have raised in this QIP. I'm sorry, what was your second question?
My related question to that was on Bangalore. You did mention that, you may be entering it a little earlier than envisaged. So is that on cards for FY23?
Yeah, we are right now at a stage where we are continuing our exploration. We are positive about what we are seeing on the ground. We see the room for our business model to be successful there. We see the gap in the market where we could play. Having said that, there's still a part of our evaluation and learning process. There is a likelihood that it will happen in fiscal 23, but at this stage we are not at a point where we have made a commitment.
Understood. Thank you. Thanks a lot, and wish you all the best, Abhishek.
Thank you, Venkat.
Thank you. The next question is from the line of Kunal Kayal from Bank of America. Please go ahead.
Sure. Thank you. A couple of questions from my side. The first one is, as you consider the next set of deals in digital infrastructure, are you also sensing any increase in the capital value of your Palava land? That's one. And then the second question, I wanted to understand the impact of price increase on your JDA model. So let's say, you would have structured for an 18% profitability in the JV model. Does a 5% increase in pricing mean that your profitability goes up to 20%, or only a part of it will accrue to you? Thank you.
Hi, Kunal. So in terms of the capital value of our land in Palava, as I was mentioning in response to a question from Samir earlier, we do expect that land values will improve as the ecosystem for digital infrastructure fructifies in Palava, and that we're already starting to see. If you see land values 2 years ago versus what land values are today, you've already seen an uptick, and we continue to see meaningful value creation going forward. Also, as Sushil was mentioning, there is a important benefit to the residential itself, which can't be only captured or measured in terms of land value. So overall, the overall value of the Palava ecosystem, we expect to continue to strengthen on account of the digital infrastructure activities. And your second question. So yeah, in terms of the economics of the JDA, ultimately different pieces are structured differently. So for example, where we have a 65% revenue share, approximately 3.5% out of that 5% would then flow to us. Where we have, for example, a profit share arrangement at 18% or 20% profit share arrangement, then we are only concerned with making sure that if the 100 has become 105 on the revenue side, then we get 18 or 20% of the new number, which is now 105. Any surplus in excess of that would go to the landowner.
Got that. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Alpesh Thakkar from Antique Stock Broking. Please go.
Just one from my side. So from the level of around INR 8,000 crore of pre-sales that we are targeting this year, where do we expect to go in next 2 years, given such a strong pipeline of business development and launches that we have? And also assuming that, most of things will remain like under industry dynamics will remain constant as they are now with strong demand. So what are our aspirations over the next 2 years?
Hi, Alpesh. Our guidance for the current fiscal is 9,000 crores of pre-sales. I just wanted to sort of make sure the number is not 8,000, it's 9,000. In terms of our guidance for the next fiscal, we are now in the process of working through it. We will give a detailed update on that in the next quarterly presentation.
Okay. Yeah, thanks a lot.
Thank you. The next question is from the line of Ritesh Pachatia from Asian Market Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So like in the last 1 year, we have seen the massive increase in the prices across the white goods, across the pipes and fittings and all the things. And this is one of the selling point by a lot of the developers. So going ahead, mainly as far as concerns the affordable category, do you think offering such kind of the fitting products or branded white good product we are stopping, and that way we are considering to reduce the cost? Do you see this can be a possibility?
Hi Ritesh, if I understand your question correctly, you're asking whether we would bundle white goods with our sales offering. At this stage, we don't really have any such scheme in place, but we remain open to evaluating whatever the consumer wants, but nothing at this stage.
Yes. All right. Sure, sir. Thank you. That's all.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for closing comments.
Thank you everybody for attending this call, and obviously in every discussions we also get some insight in terms of how do you all looking at our business, and thereby the areas potentially that we need to work more, and we continue to look forward to the similar set of conversations on and on, not only on the conference calls but even otherwise. Thank you. Thanks for attending.
Thank you.
Thank you very much. On behalf of Antique Stock Broking, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.